Hello and welcome to the Market Mondays webinar. My name is Kyle Aurora. I'm with Danny Haythorne. We are both market analysts at Capital.com. Good morning, Danny. How are you going?
Good morning, Kyle. All good, all good. Ready to look at another week. Of course, we've got to talk about the Fed last week. A few bits here and there that maybe markets weren't expecting, but overall, yeah, there's a lot to talk about, I guess. So let's get into it.
Yeah, let's crack on. We'll do the risk warnings, of course, before we get into the substantial stuff. And that's, of course, just to say very quickly, first off the bat, that anything that you hear here is of general nature only and doesn't take into consideration anybody's personal circumstances. So please consider your own personal advice or financial advice if you require it and your own risk appetite before trading CFDs. And of course, there's a spread betting disclaimer in there too, Danny, for UK clients.
Yeah, just be aware, of course, that the products that we do offer at Capital.com, which include spread bets for those of you in the UK, are risky products, and you should be aware of the risks involved before trading them with us. Also, before we get on as well, if you have any questions throughout the webinar, anything you want us to talk about, please feel free to put it in the comment section or the Q&A section down below. We'll be happy to get through the questions as we go along. And of course, this webinar will be recorded and put on YouTube after if you need to go back and look through any of the information that we've said today.
Yes, like, comment, subscribe, share with your friends, all of that sort of stuff. Let's just go through some of the things that we'll be talking about today. Obviously, like you said, Danny, the Fed was the big thing last week, and could remain sort of the big talking point throughout the end of the year because we'll get a Fed official speaking a lot before the close of 2025 and into 2026. But there was also that ever-present theme of AI valuations and where we're sitting as far as stocks right now, and that was one thing that seems to have sort of inhibited the Santa rally, so to speak. We've got some US jobs data this week and a series of central bank decisions as well. And on top of that, obviously, some UK CPI data, some PMIs as well, that will also be worth following and will inform, obviously, policy expectations into the new year. But Danny, perhaps I'll just lead you into the first comment about the Fed, which was more or less to say that markets seem to welcome what was said. And, you could probably say, at least compared to expectations or relatively speaking, a fairly dovish cut in the end.
Yeah, it's interesting because I think there was definitely stuff in that meeting that you could have pictured it either way. You could have said it was a dovish cut, you would have said it was somewhat of a hawkish cut. I think again it goes just back to how you frame it. When it comes down to it, look, the Fed did what everyone was expected. They cut rates 25 basis points. The split was a little bit maybe more uh jumbled than some would have potentially thought. I think going into the meeting, there was expectation that there were going to be a few dissenters, but I think a lot of them were expecting it to be up to five FOMC members actually voting to keep rates unchanged, more or less as a kind of standing their ground against, Fed independence and the pressure from the Trump administration to cut rates. And given that we'd had signals from Fed officials that inflation was still a concern and that they were wanting to take it a little bit easy in the easing cycle, if you may. But we did see that vote split that actually saw one FOMC member, which, as expected, it was Miran, a Trump appointee, actually vote for 50 basis points, and then we saw two vote to keep her rates on hold. So that in itself, the immediate reaction to that was taking a little bit more dovish than expected, as I said, because there was potentially less dissenters than expected before the meeting to keep rates unchanged. So that was the first initial take, was that the meeting was a little bit more dovish than what was planned heading into it. That's why we saw that initial reaction when we saw yield and the dollar down. We saw equities moving higher, and a little bit of a tentative move higher in gold as well. However, kind of digesting the information a little bit further, we kind of get this view that it's a little bit still unclear as to where the path is for the Federal Reserve. As I said, there's reasons to think that the meeting was dovish. There's also reasons to think that the meeting could be a little bit hawkish. Something that caught my attention, and something that I got a lot of media questions about the day after the Fed, was a comment that Powell said throughout the press conference. He said that rates are now very near neutral, and a lot of people kind of saw that as him essentially hinting that this was the end of the cutting cycle, that maybe there was one more cut left in the beginning of 2026 and that was it, that he was kind of adjusting expectations in markets, that that this very strong easing cycle that markets had priced in heading into the first half of 2026 wasn't going to materialize. And I think again that's what gave a little bit of a hawkish view to some people from this meeting. Markets still continue to price in rate cuts into 2026. The terminal rate, or the rate by year end next year, is still close to 3% in markets. So they're still expecting further easing in 2026, more than one rate cut, definitely. So yeah, it was. I think there was a lot to go on from the commentary and the reaction in markets, and I think, as I said, there's not a clear direction. I don't think Powell and his team aimed to give a clear direction. I think they just wanted to kind of set the record straight and highlight where things are. And I think that's where markets, again, are a little bit confused as to what exactly it all means moving forward.
Yeah, I mean, for me, the big takeaway was that there's that huge assumption underneath the Fed's projections about rising productivity next year. And, I think one thing that really caught the market's eyes from the get-go when the SEP was released was that combination that, growth for next year was revised higher. Unemployment's expected to remain relatively steady, but inflation is expected to drop from current levels and to lower than where the Fed forecasted in the September SEP. And what I think that sort of suggests is that the Fed is now a little bit like investors are. The Fed is a little bit like the investment community, which is to say that they're basically banking on the AI revolution starting to deliver, sort of tangible payoffs to boost productivity and allow the economy to run pretty hot with rate cuts and fiscal policy next year. And the economy will be more or less be able to absorb that demand because of the productivity increases. So it's a really fascinating dynamic. But it's kind of interesting to see how equity markets have responded now to this news, because it was certainly something that could have been a lot more hawkish. I think there was, I think, a lot of people going into it believing that there might have been a bit of a hawkish cut. That is to say, similar language that came out of the meeting in October, which is we're going to cut rates, but the next one isn't a foregone conclusion. And Nick Timiraos, the Wall Street Journal, I think he is, sort of Fed whisperer, gave a bit of an alley-oop to Fed to Powell during the Fed's press conference, which was, he used the term foregone conclusion. Do you more or less still believe that? And Powell sort of pushed back on that language quite a lot and really did sort of emphasize the downside risks to the labor market rather than, the inflation side of the mandate as to why the Fed remains vigilant and prepared to cut further if necessary. So that's the big takeaway here, is that I think going into 2026, the investment community as well as policymakers are coalescing around this whole fact that AI has to deliver payoffs, and that payoff of the Fed is productivity gains, a la, what happened 2 or 3 years into the internet boom. And if that doesn't materialize, then that will have to be reevaluated, not just because investors will have to reevaluate, the earnings outlook and how growth will be next year, but also the rate outlook because of its implications for inflation. So very interesting dynamic, I think.
Yeah, and I think that's where the big risk of these AI overvaluation claims come back into the market. And as you said, talking about the Santa rally and why the stock market, I think if you bring up the chart of like the S&P 500 or the Nasdaq, we'll be able to see this, how the stock market struggled to rally post-Fed. The initial reaction seemed like it was going to be bullish for stocks, and then we kind of saw a correction, and we can see now stocks again, they're not bearish by any means. There's no clear indication that this is a seller's market or that it wants to be a seller's market. But again, there's capped momentum here, and there's a lot of caution in the upside in the equity market because of these concerns about valuations, about how much further stocks can go, about whether the Fed is going to be supportive into 2026. And of course, as you mentioned, the AI trade once again causing those concerns, and there's so much riding on the tech sector, on the AI sector next year, that if we start to see any pockets of concern or weakness in the sector, that's when we can really start to see this narrative crumble and see that big impact in the stock market. And I think we're also starting to see, again, I don't think that all AI related companies are going to be able to sustain these sky high valuations. I think it is going to be a picky sector, and I think we are going to see those clear outperformance that are going to drive the market. But I think we are potentially going to start to see some weakness in some of these stocks that have overinvested in AI. And also, we're starting to see as well a little bit of a rotation in the stock market, maybe signaling a little bit of caution from investors. I don't think it's fear. I think you would see that in a flat out sell off in the stock market, but I think it's more caution. I think investors are trying to broaden their reach beyond these high yielding, high earning tech stocks, and moving more into cyclical stocks and value sectors, and trying to find maybe a little bit more diversification heading into year end and heading into 2026. Once again, just waiting and seeing whether the next set of earnings can actually prove that these valuations can be sustained further.
Yeah, I think the rotation last week was quite interesting because I think it spoke to two things. One, sort of changes in the rates curve, and there was that really significant drop in the front end, partially because of hopes that the Fed will cut further from here. Also, perhaps because of the change to the way that they're going to be managing their balance sheet going forward. There was also, though, of course, this kind of question of whether we've gotten to this point in the AI cycle now where we've, seen a big boom in, the semis and raw materials as well as a corollary of that. The hyperscalers have, obviously developed products and services which, to some extent that they've monetized. But what investors are looking for now is a little bit like what policymakers seem to be implying, that mass adoption of artificial intelligence across the economy, so end users to drive productivity gains and therefore higher profits for those cyclical companies who are going to be, in principle, those that will be using AI to improve their businesses and increase their profitability. And that seems to be a very sort of tentative dynamic that is playing out. I think even Ray Dalio may have spoke about it a couple of weeks ago about this potential stage in the AI cycle is being reached. But I think it really does raise the stakes a little bit. Once more, to go back to that point earlier, that not even if just what AI does and how it impacts the economy, but also when is going to be crucial, because everyone seems to be positioning for it to be a 2026 thing. And even if it does prove to be a hugely beneficial and impactful technology that does drive growth and productivity gains, maybe it doesn't happen in the timeline that investors are pricing in, and that would still be, I would say, a dynamic that might see, valuations compress a little bit to sort of moderate some of that excitement. And we've just stared at the S&P 500 for a little bit, but the Nasdaq and the divergence between that and more cyclical indices. So there you go. The Nasdaq hasn't made another high. The S&P 500 is basically range bound, and I would say just very quickly a drop below 6,500 would be that bearish signal that you might be looking for. With the 200-day, 200-day is a long way below that. But range bound for the S&P 500, the Nasdaq's made a lower high here, but the Dow hit record highs, and the other really interesting one too was the Russell 2000, which I'll try and get up to just for the sake of illustration. I'll just get the futures up for the hell of it. Same, but different. Russell hit another record high too. So there is that move into cyclical small caps in particular. But it's a kind of a tentative move, and again, all very much predicated on whether the kind of benefits to AI start to ripple through the economy, the US economy more broadly.
Okay, we said we've got another busy week ahead this week. We've got a few central bank meetings, but we also have some data on the economic calendar. All the central bank meetings are happening towards the end of the week. They'll be on Thursday and Friday. Before that, we actually have quite a bit of data coming out. We've got jobs data in the UK, in the US. We've got inflation data in the UK and in the US as well. We've got PMI data. So there's quite a lot in the calendar. And for the US specifically, this is the first month where we're actually seeing that restart of normal data publication after that shutdown. So we'll have, I believe the PC data will be for October, so that's still delayed, but we'll have US CPI and US jobs data for November. So once again, giving markets an insight into how how the economy has been evolving. So there'll be quite a lot to watch out for there. Just looking there at the headlines, I think you've got them pulled up. We've got the PMIs coming first. The PMIs will be coming tomorrow, I believe, on Tuesday. And then we'll have the next one will be the UK jobs data, looking to see whether earnings have increased at all, whether the unemployment rate has remained unchanged at 5%. And of course, we'll also have inflation from the UK as well, heading into that Bank of England meeting on Thursday. So it'll be quite an interesting week for the pound and the FTSE to see how all of that data plays in, specifically because we still have stagflation fears. So the markets will want confirmation that the disinflation process has returned in the UK and that there is confidence that the Bank of England can actually cut rates at this meeting without having to, be too concerned about inflation. To some extent, they will still have to be. It's still well above that 2% target, but that disinflation process will definitely give a little bit more securance to the market. And we'll also have, as I said, that jobs data from the US and the CPI data from the US again to see how the US economy has evolved. Kyle, do you have any expectations about this data heading into this week?
Yeah, well, I mean, let's look at just the jobs figures in the States. Expected to see an unemployment rate that ticks up to 4.5%, and a jobs gain of about 50,000 or so. Um, should be really fascinating because again, when it comes to what the Fed was telling us last week, is that it's much more focused on the labor side of its mandate rather than inflation. And if we do get this kind of signal from the data that there's slack building in the labor market, that might sort of provide that extra impetus for the markets to bring forward the pricing of the next rate cut, which, there is kind of the expectation now for, if we look at things on a sort of a forward-looking basis that, January will see a hold of policy rates. That the balanced probabilities that we'll also get a little bit of a hold coming through in March as well, but the next move won't be until April. And so if we start to see this evidence, which it would appear based on what was sort of speculated based on Powell's language in the press conference last week, that maybe, because obviously, they're not relying entirely on the official data to provide a picture of the US economy. They've got teams of economists that are trying to assess these things in real time. That maybe some of that dovishness that came through was an indication that actually the data this week is going to be potentially a little bit soft, and that's going to reinflame fears about a deteriorating labor market and weaker growth in the United States. So fairly crucial, but obviously it has to be balanced against that expectations of a for the PCE read in particular. Obviously, the CPI data will be important as well, but the PCE read when we get it too, of the prospect of fairly sticky prices, which remain more or less or more than likely going to remain around 3%. So effectively, we're going to get a very nice kind of litmus test of the balance of risks in the US economy this week. And you could argue that all else being equal, if we do get a slightly sluggish labor force report, a labor market report, and then some tame inflation data, maybe that'll be enough to start pushing Wall Street on this kind of Santa rally that everyone has sort of hoped that maybe the Fed would have sort of heralded, and by extension of that too, maybe that kind of sell off in the US dollar and something we'll talk about in a second as well, that further strength in gold prices, which are close to record highs too.
Yeah, it'll be interesting. We didn't actually see the official CPI data for October. We kind of jumped from September to November, whereas we're going to get the PCE for October. I think it was last week that we just got the September reading for the PCE coming in at 2.8%. The CPI, the last reading, which was the September reading, came in at 3%. So it'll be interesting to see how markets react, maybe in the difference between these two readings. I think that 3% handle number is what continues to cause a little bit of concern. I think if we were to see the CPI drop below 3%, and the PCE also remained where it is, not seeing any increments there, I think that's when you start to see that, as you said, that relief potentially into the stock market. If we do get that softening in the labor market, as you said, that may be the catalyst to push equity markets higher. But of course, we'll have to see how that data comes in. We also have the PMI data as well. So there's quite a lot coming out this week. And of course, finishing off the week, we'll have the central bank meetings. As I said, we have the Bank of England and the ECB on Thursday, and then we'll have the Bank of Japan on Friday. I'll let you talk about the Bank of Japan if you want, Kyle. But from the BOE, as I said, a lot of it's going to be on that disinflation trend, whether it's able to confirm with the data that it's continuing. Of course, the Bank of England is expected to cut rates. The current pricing is around 85%. It has softened a little bit towards the end of last week. It was around 92%. So it has softened slightly, but I do think it's the path of least resistance or the path of least regret for the Bank of England to ease rates. They have seen inflation soften slightly in recent months, so it has opened the door a little bit, and the labour market continues to be a concern. We also saw growth data last week from the UK once again show a contraction in the monthly reading in October, coming in at minus 0.1%, but also for the 3 months to October as well. So again, the UK economy is not in a great situation. There are concerns from growth. There are concerns from the fiscal outlook. So, of course, stagflation remains on the table. So the Bank of England is going to be very careful with how it proceeds and, of course, its messaging as well. So I think the best case scenario this week, inflation comes in a little bit softer, once again, opens that door for the rate cut, cements the views that the disinflation process is back and that there are potentially a little bit less concerns about stagflation. So that's probably the best case scenario for the UK, definitely for the FTSE. This week. The pound, again, will just depend on this playoff. As we know, easing policy tends to weigh on a domestic currency because of yield differentials. But if we do see a little bit of a sense of security with this cut about the UK economy, we could potentially see the pound remaining a little bit bid on the back of that. So it's all going to be about the narrative and about how it's framed by the Bank of England and, of course, the data as it comes out. Regarding the ECB, no change expected from them. Currently, 99% chance that we're not going to see a rate cut or a rate hike from them. We've said in the past that the ECB was very good in front running the easing cycle. They managed to get rates down to 2%. And also inflation remaining pretty stable. It's actually pretty close to that 2% target as well. So not much expected from the ECB. Watch out for many messaging from Lagarde. But I think in terms of European assets, they're pretty much focused on the wider narrative in markets, the risk appetite we're seeing in markets.
Yeah, I think one thing that's going to be really pertinent next year is this notion that the global and synchronized rate cutting cycle that we've seen over the last year and a bit, which has basically been the case in developed markets, could be coming to an end. We'll see a much larger divergence in policy between different central banks. We saw it at the start of last week with those comments from Isabel Schnabel about the possibility the next move from the ECB could be a rate hike. The RBA is entertaining the same kind of conversation at the moment that will policy actually have to be tightened next year? And then, you've got the BOJ this week that it's expected will deliver a rate hike. And of course, everyone's got these fears about the yen carry trade and all these sorts of issues, which, funnily enough, that happened in August 2024. That came after the BOJ hiked rates by a little bit more than expected, and the US jobs data was a little bit softer than expected a few days later, and we saw this big meltdown in markets. So, that doesn't necessarily predict that there'll be anything of the sort this week, but it's just interesting to note that we will have practically two major events that were influential in that particular meltdown happening in the space of sort of 48 hours again. But the point is that there is going to be much greater volatility in rates and currency markets next year, just by virtue of the fact that we've got a Bank of England that's going to be cutting rates, it would seem, at least this week, a BOJ that's going to be hiking rates, and ECB that will be leaving rates on hold. It's a nice little kind of microcosm for what I think 2026 will be. When it comes to the Bank of Japan, I mean, all the ducks have been sort of lined up from both the central bank, then also the data, and then also the notable quietness from the Takaichi government about monetary policy that effectively rates will be hiked. The question will be ultimately, of course, how many hikes are there to come? And there was some leaks to the media last week that maybe there could be a more aggressive rate hiking cycle in Japan than previously thought. And of course, this comes because of persistent inflation in Japan. We've already seen, you know, inflation remain very close to 3% for most of 2025, despite forecasts that it would moderate slowly over the next, call it 12 months or so. And then we've also got the political developments, which could lead in Japan over the last few months, which could lead to much more fiscal spending than previously anticipated. And that's going to be an inflationary driver going forward as well. So, with all of that said, it is a question of to what degree is the BOJ hawkish and flag further rate hikes to come. I suspect that given policy remains very, very accommodative already by the BOJ's own logic, real rates remain quite negative. There could be much more hiking in the future relative to the BOJ's history. It's not going to be a 150 basis point, 200 basis point, 350 basis point hiking cycle, but we could be looking at another 75 basis points of hikes, including the one that's assumed to come this week. And that's going to have a pretty significant impact on the yen, which I think is starting to look like it's turning higher. USD JPY turning lower, as you can kind of see that momentum fade there. And that's going to have a knock-on impact to the Nikkei as well, which if we see on top of that too, some jitters around global equity valuations, perhaps we're due for another kind of deeper pullback in Nikkei. Again, if we get that kind of hawkish BOJ.
I think, Kyle, we can look at a few questions now. We've got quite a few coming, looking at specific markets. I can take the first one if you want. We've got one talking about specifically about nat gas and oil, about a few events that have gone on, most specifically, the US seizing of a Venezuelan oil tanker, which has been in the news over the weekend. There have been reports that Venezuelan oil exports have actually fallen sharply since the US seized its tanker. This is essentially because companies and consumers are concerned about the US seizing further Venezuelan oil and therefore their shipping's not being delivered. So, of course, this has an impact on the demand. However, Venezuela isn't a massive global producer of oil, not if you compare it to other big ones like Saudi Arabia or even the US. So there'll definitely be impact. I think it's definitely a bullish catalyst for the oil market. However, I think if anything, Venezuelan supply helps soften the tightness elsewhere in the world. I don't think it creates I don't think it has a massive market compared to some of these other exporters. So I think the fact that Venezuelan oil is at risk is meaningful, but I don't think it will be the most impactful for the oil market. In fact, if we look at the performance over the last few days, we haven't seen that much of an impact. We still continue to see that downside pressure in US crude, in Brent as well. So all in all, I think it's something to watch out for. I think it does add a layer of risk premium to the market, and I think that's something that could potentially see a little bit of volatility. But I think the event itself is quite isolated, and I think the impact is also quite isolated. The second part of the question is, of course, nat gas and tensions in Ukraine. Again, similar story there. Ukraine and Russia tensions will have an impact on the energy sector, the nat gas sector, and specifically. I think a lot of it depends on the impact that it has on Russian exports, shipping routes, specifically in the Black Sea, whether once again we see an increase in risk premium, geopolitical risk premium, and whether traders perceive that there is an increase in supply risk and therefore potentially demand outweighing supply, and that's when we see price tightening in the market. But all in all, I think it's definitely an added layer of risk premium in the energy market. I think it's something to continue monitoring. The Ukraine-Russia story isn't new, so again, the impact may be limited on there. When it comes to oil, something to monitor, expected to see the exports of oil from Venezuela drop on the back of this seizing of the tanker. But again, not a massive exporter, so the impacts may be limited.
Yeah, I suppose with oil and natural gas, I don't follow that much, but there really does seem to be a desire from, OPEC to keep that price in the sort of high 50s, low 60s. That's their desired range. For what it's worth, the US seems to be perfectly happy with it there too, to sort of balance the need for lower sort of consumer prices, as well as, keeping their energy complex reasonably well supported. But that sort of 50-day moving average seems to be a level that traders have faded any rally from. So if that breaks, maybe a push back towards that kind of 60, 62s, 200-day moving averages are at 63 at the moment, could be in play. The key level of support, obviously, $55 per barrel. Maybe even just round it out with gold.
Yeah, we have a few
Uh,
questions on gold and silver, so maybe we can take a
all
look
right.
at those.
Gold is the most textbook bull market that you can possibly imagine. It's driven by probably tailwinds that aren't as strong as what we saw back in October in the last record high. And I only say that because some of the geopolitical risks, relatively speaking, have diminished, and obviously trade policy is far in a far better position than where we were back then. But nevertheless, the major drivers here is, of course, rate cuts coming through from the Fed and more to come as far as market pricing is concerned. I would say fiscal profligacy around the world, where fiscal settings are going to be made to run pretty hot in different markets. And then there's also, that perennial issue of Fed independence and maybe policy being sort of lower than it would otherwise be, because we might get someone like Kevin Hassett. The name Kevin Walsh has been thrown around a little bit too, as far as the next Fed chairperson, who is, at least based on his history, far more of an inflation hawk than sort of an employment dove, so to speak. But nevertheless, you can sort of respect the price action here. And what gold does very well is that it consolidates, it breaks out, it consolidates, it breaks out. And after that pullback that we saw from the October high, we've consolidated, broken out, and we're now only, less than 1% away from those record levels, which are, if are breached, tend to be a fairly bullish sign. So for me, gold remains this kind of manifestation of markets worried about policy being too loose next year, perhaps. There also being the added concern of inflation remaining reasonably stubborn and not being tackled by central banks. There's all those other things like central bank buying, which sort of dovetails into not only that, but some of those other issues too. But nevertheless, super constructive for gold. And if it hits another record high, it's very difficult to feel bearish despite the extraordinary returns that we've seen on gold for the last couple of years. Silver's an interesting one too, because we've seen a little bit more volatility in it. I don't know if Danny, you want to take the reins on that one, because the precious metal
Yeah,
continues to shine right across the board.
yeah, I think silver looks a little bit too speculative for me. I think you can see there both on the weekly and the daily chart, we've kind of got that exponential gains happening. There hasn't been a real test of the bullish appetite, aside from a little bit of consolidation there at the end of November. It looks like the momentum continues to be the upside. Fundamentally, the key story here has been for a while, aside from the safe haven demand that we get from the precious metal side. It's also being driven by the expected tightness in supply from the industrial side. It's expected to see that over the next few years, there's going to be a shortness of supply of silver, considering how much is being used in the semiconductor space, in the electric vehicle space. So from the fundamental side, it continues to be very constructive in the long term. However, the chart looks quite speculative. I think there is a lot of over positioning here in the market. That doesn't mean it can't run further. We've seen it run quite hot for a while now. You were seeing there on the weekly chart, I think it's been 4 continuous weeks of upside with no test and on the momentum. You can see here just how speculative it is, how exponential the rise has been. Yeah, path of least resistance, some would argue continues to be to the upside. I think it's primed and ready to see some sort of pullback. But we'll just have to see where the momentum comes from.
Yeah, and maybe I'll just see if I can get it up very quickly. Just the silver gold or gold silver ratio, just
Yeah, that's definitely
flashing.
one to watch out for.
Yeah, just as a bit of a signal that maybe things have run a little bit too far. Let's see if I can get up on trading view.
I think it dropped to the lowest in what, 4 years or something like that. I think.
Yeah, and then I think it might have even gone on even further than that after we checked it last. But it's just one of those things that's sort of worth noting that we haven't seen these levels since what's that? Basically the pandemic when we saw that kind of uber meltdown um, in, or not meltdown, I should say, kind of, surge in silver relative to gold. So something to keep an eye on. Maybe we're trading at sort of extremes when it comes to silver against gold. Um, let's leave it there, Danny, for another week.
Yeah, for sure. Thank you everyone so much for joining us. As always, this has been recorded. It will be posted on YouTube and we'll be back here next week, same time, to run you through the markets once again.
Beautiful. Have a good one, Danny.
Bye, guys.